Hi guys, in this video we will be discussing about the full disclosure and the matching principle of the accounting principles and conventions. Matching principle. The principle states that the expenditure or cost of the business of the accounting period should be matched with the revenue of the period to ascertain the profit or loss. The expenditure of the period should be compared with the income of the period. According to this principle, the expenditure of a specific accounting period should be compared with the income of the same accounting period. That is, if an expenditure is incurred in 2018, the same should be compared with the income of 2018. And again, if the cash payment is done in 2019 for the expenditure incurred in 2018, the accounts should be written in such a way that the expenditure is incurred in 2018. To understand more clearly, let us go through an example. If salary is paid on January 2020 for the service rendered in December 2019, the cost should be matched with the December 2019 even if the payment is done in January 2020. That is, even if the cash payment is physically done in January 2020, the payment should be recorded in the books of accounts as the expenditure which is supposed to be given in 2019 December. It is because of this concept adjustments are made for outstanding expenses, accrued income, prepaid expense and unearned income while preparing the final statement. I will give you the meanings of these terms, and when we start the problem you will understand what adjustments mean, what adjustments we use to adjust these concepts. Outstanding expense means the payment is already due. You're supposed to pay the money, but you have not yet paid. And accrued income means the payment is earned but not received. And prepaid expenses mean the payment is not yet due, but you have already paid it. And unearned income means the income which is not earned. And the outstanding expenses are a liability and prepaid expenses are income or asset to the company. And you will understand further when we start doing the problems. Full disclosure. This convention demands that the accounting statement should disclose all material facts to all the stakeholders. This convention becomes more important in the case of joint stock company where the ownership and management are separated. According to this concept, all relevant information about the business or the accounts should be disclosed to the stakeholders or the interested parties. That is, when I say stakeholders or interested parties, it is the debtors, creditors, shareholders, the employees, the management, the other government, or anybody who's interested in knowing about the business is the stakeholder. All the relevant information, whatever is relevant for each stakeholder, should be properly disclosed to them. This concept gains importance when it comes to a joint stock company where the management is separated from the shareholders or the actual owners. The management is the one who is actually working in the company, but the stakeholders or the shareholders or the owners of the company just come in during a shareholders meeting, maybe twice a year or once a year. So whatever relevant information should be provided by the management to the shareholders who are the actual owners of the company. It may include proper profit and loss account or a balance sheet or any material facts which the management or any other stakeholder is looking forward to. Reference Accountancy 1 by P.K. Lazar.